All right, so gonna pick up where we left off yesterday. So yesterday I created the fire fusion strategy, the fusion effect strategy. Okay, using my Fibonacci bands and my Doji scanner. All right, and basically, there's been some individuals that had a hard time understanding how to put this on the chart. So you do have to be a premium member, all right, or a paid member of TradingView in order for you to get access to some of these special indicators. But once you do have that, you just click on share, and then you will click on make it mine. And then right from here, okay, it'll pop up in your screen. You could go over here, hover your mouse on indicator templates, click save indicator template and save it. All right. All right, and that's the quick way how to just simply save this. All right, so if you're still having difficulties with that, let me know. But yeah, chances are you don't have access to the premium TradingView. All right. With that said, here's how the Fibonacci bands look along with the Doji scan. So let me just remove everything all together. All right, this is what we got. Let me show you once again. All right, you're gonna have to get the premium version. Okay. All right, let me remove all the drawings, and now you have the Fibonacci bands and the Doji scanner. All right, now when I go in here and I click style, all right, we can, highlight what we want to highlight. These are all dojis, by the way, which means these are candles that will eventually reverse. Of course, considering SRT, support versus trend line levels, and just price action, how the market is going. All right, very simple to identify potential, trades. So when it's in a white zone, most likely the market is going to go up. When it's in a red zone, most likely the market is going to go down. There are going to be some times where the market just kind of dances in an area for a while. There's really nothing we can do about that. So the ideal thing would be to combine your SRTs with this, support resistance trend lines. You guys already know how I like to do. I like to use my horizontal ray to mark up my highs, to mark up my lows, to mark up my trend lines, to mark anything that I think is worthy of note, right? So, for example, here we go. All right, you're gonna start to notice, things time and time again. Now, when you use the Fibonacci bands and the Doji scanner in combination with the Fibonacci retracement tool, then you can really get far with that. So let's go over here to the Fib tool, Fibonacci retracement, and we're gonna take it from wick to wick. All right, so from swing low to the swing high. Okay, I'm looking right over here, wick to wick. We're gonna do wick to wick. I'm gonna drag it out over here just so we can see it better. All right, and what we can find is basically this. When we see a pullback, most likely, all right, if it's a pretty good pullback followed by a continuation, it'll bounce right around the 50 to 618 area. Some people consider this the golden zone. Okay, so Fibonacci, the Fibonacci sequence is a sequence of numbers. It's a sequence of numbers, and it's found in just about everything that is in everything that falls under God's creation, which is everything. I want you guys to definitely take a good look at this. Just real quick, I'll give you a real quick description. Hey Google, describe the Fibonacci sequence.
On the website imaginationstation Toledo.org, they say, The Fibonacci sequence is the series of numbers where each number is the sum of the two preceding numbers. For example, 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, 233, 377, 610. People also ask me, how would you describe the Fibonacci spiral? Want to hear the answer?
No.
Okay.
Hey Google, what is the Fibonacci retracement tool used for in trading?
On the website cmcmarkets.com, they say, Fibonacci retracements are a popular form of technical analysis used by traders in order to predict future potential prices in the financial markets.
Wasn't much of an explanation, but basically, the golden zone is between the 50% point and the 618, point over here. Okay, so notice that the market is going up. Okay, here's a small pullback, small retracement, right before the continuation. This is small as whatever. But notice right when it gets to the 23.6 area, right, it starts to drop down and it retests the 618 zone. So these lines aren't going to pinpoint exactly where it's at, but it's going to give you the idea of where the market is at. And we see it worked over here several times before the continuation. Now, finally, as it continue, it's getting close to the 0 point. At this point, there's a good chance that if it doesn't respect that level, it's going to drop from that level and probably retrace to another point, And so if we use the Fibonacci tool again, right, and we're taking it from the swing high to the swing low, this case, let's look at it right here, okay? And here is the low point right around over here before starting to probably come back to that area. Notice, all right, this thing drops, okay? It wicked right over here between the 50% point and the 61.8% point, right? It wicked hard over here, came back, came right back down, all right? Now it's testing the 50 line again, and so we may see something interesting. Here's a pullback. It may touch the 618 before it's ready to drop down. So the market had a lot of strength, a lot of bullish power to get to this point. But now it seems like it's pressing the brakes, and so we may see something pretty interesting. But for the most part, when you see it more on the bigger time frames, or you scale out a little bit, see the bigger picture, then you're gonna start to notice a couple of things. So using the Fibonacci bands in combination with the actual Fib tool, this could really go pretty far for the most point. So right over here, there's a straight red zone. We got a doji over here. Okay, this is the gravestone doji. All right. So the doji scanner is definitely working. Dojis are a sign of potential reversals. Okay, so you see how this was a pullback, and next thing you know, it was a bearish doji. It ended up still going up. So you're gonna notice certain things when it comes to that. All right. Now with that said, I do want us to talk about Fibonacci just a little bit more. Okay, we're gonna talk about it just a little bit more. Let me X this out. And all right, here's what I'm gonna do. I'm gonna go into one of my layouts. All right, let's load one of my layouts over here, and we're gonna do the Fib retracement. We're gonna do a Fib retracement guide. Okay, and so here's a visual for you to have. I'll snapshot this and I'll send it to you as a digital gift. All right, but let's read. Okay, Fibonacci retracements, Fibs for short. So when we use the term Fibs, it's dealing with Fibonacci retracement. are a set of ratios defined by mathematically important Fibonacci sequence. This allows traders to identify key levels of support and resistances for price action. Unlike other indicators, Fibonacci retracements are fixed, making them very easy to interpret. When combined with additional indicators, Fibs can be used to identify potential entry and exit points with high probability to trade on trending movements. So notice that when I did use the Fib tool, right, is because we were looking at this uptrend, right? This is possible this is the beginning of a downtrend. It sure looks that way, right? But let's say if I used the Fib retracement tool going from the swing high to the swing low over here, we might be able to see some interesting stuff, okay? So right over here, 618, 50% point, right? Look at this. So market drops down, boom. What happens? It starts wicking in these areas, all right? Drop, wicked again right over here, all right? Between 618 and 50, all right? Look at this. And it started working its way down. Once it got to the 1 point, it's like, okay, this is either going to continue going south or it's going to respect it as a support. Respect it as a support. What ended up happening? Uptrend. Uptrend right after. Okay? And look, uptrend right after. Bam. All right? So we're using the Fibonacci retracement tool again. We're using the Fibs again. All right? We could go from the swing high in the wick, all right, to the swing low, which is right over here. All right, higher time frames will be better, but even in small time frames, you can actually start to see some stuff. You can actually start to see some stuff. It's going to be a little better with the higher time frames, but you know you're starting to get the point. Sometimes you're going to notice that the market is going to honor some of these Fib levels in at different points. So maybe it's not honoring anything on the 4 hour, but it could be honoring something in a 15 minute, right? In a 15-minute time frame chart. Right? Or maybe the 5 minute, okay? Or maybe the 1 hour. So you just have to scan the market. You have to, top-down analysis is usually my way to go. So I start with the higher time frame, like the weekly chart, and I start skipping down, certain time frames, certain key level time frames. So if I'm looking at the 4 hour, I don't like to just go to the 1 hour. I already kind of saw what's up, you know what I'm saying? So I'll skip from the 4 hour to the 15 minute. But of course, you can analyze it however you want, whatever's going to make sense to you. The golden zone is usually 618 to 50. And if you really think about it, all right, 786 is the reverse of, 786 is the reverse of 236. Okay, 382 is the reverse of 618. It's all in sequences. I love the way this actually works and operates. It's going to take a little bit of practice before you start getting used to it, but this is good because like I was stating before, all right, like I was stating before, if we notice the market is trending up, it's going to be moments where it pulls back down, right? We're going to notice that. These are called pullbacks. These areas over here, they're pullbacks, okay? All right? There are pullbacks. So the market is pushing up, and then there's moments where it's kind of slide back, pushes up, slide back, pushes up, slide back. So these are the pullbacks right over here. The idea would be to get in right at the peak of those pullbacks if you're going in on these buys on an uptrend. That's the idea. And when it comes to a sell, it's going to be the same thing. The market's going to go down, followed by some pullbacks. All right, whether the pullbacks are small or big, all right, you're going to see a pullback before the continuation of a trend, if it's actually still trending in that direction, okay? Ideal thing to do, especially in a downtrend, is to catch some sells on a downtrend right, at the peak of the pullbacks. Okay, so when the market is going up, you're looking at the higher lows. All right, when you see that the market is dropping down, all right, you're searching for the lower highs to buy. Okay, all right, now what the Fibonacci tool is going to show you, right, it's going to show you where the markets may just retrace to. And you're going to notice multiple touches. So right over here, we see there's a few, all right, times that the market wicked right around this area. Okay? You're going to see that there's a reaction point. For sure, there's a reaction point. All right? These are reaction points. So it's important. So that's pretty important. Okay, so with that said, it's good to really be observant as to what's happening with the market. All right, now let's go back. Okay, so this is what it looks like on a Fibonacci bullish, type of situation. This over here will be bearish. All right, so bullish Fibonacci retracement lines. All right, if we look at this, okay, this is the swing low. Think of the candles wick to wick, right? Swing high. Think of the candles wick to wick. Okay, now check this out. The market here goes, starting to push up, pull back. All right, here's a small retracement. Okay, the trend continues. Okay, so pull back into continuations. Hit the 618. Okay, starts to come back. Hit the 100% point. Cool, it completed it. Right, now it's respecting this level. Boom. The chances are that it's going to come back to 618. Somehow, some way, it's going to come back and then do a big continuation. All right. And if you look at this, this really looks like Elliot waves, which we're going to cover as well. All right, so let's read. Retracement levels for a stock or a trading asset, because we are trading Forex, we are trading crypto, we are trading indices. So retracement levels for a stock or trading asset are drawn based on the prior bearish or bullish movement. To plot the retracements, draw a trend line from the low to the high within the continuous price movement. Fibonacci retracement line should be placed at 61.80%, 38.20%, and 23.60% of the height of the line. In the bullish movement, the retracement lines start from the top of the movement. All right, for example, the 23.60% line is closest to the top of the movement. Okay, whereas in the bearish movement, the retracements are calculated from the bottom of the movement. For example, 23.60% line is closest to the bottom of the movement. All right, so long story short, y'all, you guys see what's up over here and over here. All right, let's go and continue reading. Whenever applying Fibonacci retracements, keep in mind that retracement lines represent potential support and resistance levels. They represent price levels at which to be alert rather than hard buy and sell signals. It is important to use additional indicators, in particular the MACD, which we did cover, to identify when support or resistance is actually being encountered and a reversal is likely. The more that additional indicators are pointing towards a reversal, the more likely one is to occur. Also note that failed reversals, especially at the 38.20% and 50% retracement levels, are common, right? So we did cover MACD in full detail, and you forgot about that. All right, let me pull that up for you. Because I know we did cover this in straight detail. All right, you guys remember this? Remember how I covered this? Okay, Now, right over here in this indicator window, this is the true MACD over here. All right, if you remember correctly, okay. So basically, the MACD has a signal line crossover. So whenever you see, okay, the blue line crossing up the signal line, that's a trigger for a buy, hence the green flag. If you see the blue line, think of it as the profit line crossing down the signal line, all right, that's an indication for a potential sell, okay? The bars you see over here is the histogram, all right? So you're going to see, all right, there's the moving average, convergence, divergence, all right? So whenever you're looking at the charts over here in the top, if you start to see a trend happening, yet the reverse is happening on the MACD, that is a sign for a potential reversal. So if you're using the MACD, all right, in combination, all right, with the Fibonacci retracement tools, now you're getting into some juicy stuff over here. So I actually do have, I have a custom indicator on MACD, but let's not even go there. We could go with a regular MACD. I don't know. Let's go with a crossover one. Let's see. Here's one that's already on the TradingView library. That's not mine, but it's for premium members. You know what? No. Let's keep it simple. MACD. Moving average, convergence, divergence. All right, so here you go. Okay, you want a more customized one. You know, I like custom stuff. H Potter be doing some crazy stuff too. Yeah. Okay, so I guess it's no longer in circulation. All right. All right. It looks like some of these aren't updated or whatever, so I should have another one. I should have, oh yeah, my modified histogram. That's an OG one. That one is from 2018. All right, there we go. All right, so you could go with some custom ones. You go with just a regular one. That's fine. You can do whatever you want. But again, you could see a potential trend happen right in front of you. Look at this crossover over here, and it's already at a resistance level, and it looks like it's still going pretty strong. But yeah, you want to use different indicators in combination with the Fibonacci retracement tool. All right, and it'll just help enhance your analysis in that regard. Okay, now so we covered this is very simple. Let me actually okay. All right, something simple. All right, I'll send that in the group just so you can have it. All right, and okay, so for right now, that's what it is. Okay, now notice these does look like Elliot waves. We could do a whole class on Elliot waves, literally like right now. look, I don't even know how long I've been recording, but what I will say is I could cover that whole thing right now. But I think what I might do, should I cover it now? Yeah, I should. Let's just get it over with. All right, so all right. Let's go and let us start covering Elliott waves. All right, because what we're looking at when we are looking at the Fibonacci and how it works, it only makes sense that we start covering Elliott waves because it sure definitely looks like it. Okay. All right. So peep this. All right. How in this example, this sure looks like Elliott waves, right? See if I can get this on board. Yeah. Okay. All right, let us first cover the overall Elliott wave cycle. Okay, look at what we were just learning when it comes to Fibonacci retracement levels, so on and so forth. The market moves in waves. Okay, Elliott waves, all right, particularly are constantly in our face. All right, so phase one, the motive phase, the numbered phase. All right, so if you look at the numbers, that represents phase one. If you look at the letters, that represents the corrective phase. All right, that's phase two. All right, so what you're going to see is you're going to see, here comes a move up, okay, pull back, move up, pull back, move up, right? That completes the motive phase. Then you have the corrective phase, okay? A, B, C. The market is going to move in waves like that. There's nothing you and I can do. It's just the way it is. So the rules, okay? Wave 2 should never go below wave 1, okay? So we look at wave number 2, which is this one, okay? This is the completion of wave 2, all right? This ain't going to go below wave number 1. So this is wave 1, and this is wave 2, all right? This completes wave 2, okay? Wave 3 is never the shortest wave. So usually wave 3 is the bigger push in comparison to 1. Or maybe even, just slightly different, just slightly higher. Okay? Wave 4 never overlaps wave 1. So we look at wave 4, this is not even overlapping with wave 1 at all. So this is a true phase 1 motive phase Elliott wave cycle. Okay? Phase 2 corrective phase. All right. Now this is basically it starting to retrace a little bit. Right? We just learned about Fibonacci retracement. Now I'm going to read. The very first step is to look at the overall market cycle. The overall market cycle consists of only 8 waves. Okay, so 5 plus 3, that's 8. Which is then divided into 2 phases. For simplicity, I will be only referring to the bull market variations as the bear market is the same in opposite formation. Okay? So basically, if we're going to draw out the bearish waves, it'll be the same except that it's the exact opposite. Okay? So just get the gist over here. If you really need the visual, let's make it real quick. If you really need the visual. So remember, okay, there's going to be the motive phases followed by the corrective phases. All right. So in this case, instead of pushing up, we're pushing down. Okay. Boom. That's wave 1. Okay. Wave 2. Wave 3. wave 4, wave 5, followed by the corrective phases. A, B, C. You're going to see something similar like this again and again and again. All right? But anyway, phases. Phase 1 consists of motive numbers, all right, which are shown in numbered format. As shown above, the label 1, 2, 3, 4, 5. Phase 2 consists of 3 corrective waves or different variations and are labeled as alphabet letters. Simply put, waves 1, 3, and 5 are directional primary trend movements. They are separated by waves 2 and 4, which are counter trend lines, aka corrective waves. Now, it ain't going to be perfect like this that you're going to see it in the chart. All right, let's give you a little bit more sauce over here. This is more like what you're going to see, okay? Here's the compounding structure. The most important basic structure is making sure that you understand how time frames and cycles are intertwined. If you look at the chart above, you could see the wave 1 and 2, but on a larger scale, has more details. One 5-wave structure is a single entity of a 5-waved pattern of a larger degree. You understand what I'm saying? You understand what's going on over here? So there are layers of different Elliot waves working, right, simultaneously. Okay? So one 5-wave structure is a single entity of a 5-wave pattern of a larger degree. It could also be subdivided into a 5-wave pattern in a smaller degree. Confusing, right? Memorize this. All right, let me kind of zoom a little more. Okay. There we go. All right, this is gonna fit much better together. Okay. All right, so the larger wave, all right, 1, can also be subdivided into A, B, C wave. 2 is then considered a corrective wave on a primary scale. Its wave A and C are considered motive waves as they point to the overall trend direction of a correction. A 3-wave movement is considered a correction of a 5-wave pattern 1 degree higher. Waves 1, 2, 3, 4, 5 can also be subdivided into smaller versions of themselves. Another useful tip is that it is not useful for everyday application to go too deep within the time frame perspective. A 5-wave motive pattern can usually be seen clearly on the 1-hour chart, on the 4-hour chart, and on the daily chart, which is the best to use Elliot waves. The whole point of all Elliot waves is to look for the best entries and making sure whether we are in a continuation, as Elliot waves can give you a good position for an upcoming momentum swing. All right, so this is the basic gist of Elliot waves. All right, we're seeing Elliot waves all the time. All right, we're seeing Elliot waves all the time. All right, so let's we could keep moving, we could keep going. All right, and here we go. We can keep this moving. Okay. Let's talk about it. Motive waves. There are only 2 types of motive waves: impulse and diagonal. Impulse waves, okay? As previously discussed in chapter 1, motive waves are subdivided into 5 waves. These 5 waves always move in the same direction of the current trend by degrees. The counter trend of wave 2, okay, which is this one, the counter trend, because it's not going with the trend, it's counter trend. The These 5 waves always move in the same direction of the current trend by degrees. The counter trend of wave 2 never moves beyond the beginning of wave 1, and wave 4 moves never beyond the beginning of wave 3. The impulse wave is one of the most common of wave types. In the impulse, wave 4 never overlaps with the high of wave 1. Wave 1, 2, 5 are what is called motive. Also, wave 3 is never the shortest wave and always an impulse. Now, you see number 2, the second type of motive waves, diagonal or leading wave. All right, so rules. Wedge shape with parallel or contracting trend lines. All right, so you can see, all right, if you're looking here, because right over here, we're looking at the higher highs, okay, followed by the higher lows, okay? Higher lows, higher highs. We're looking at it. It's you know, basically following in its own direction, but eventually it's gonna start to kind of create like that flag pattern, right? That wedge, okay? And so it's just like all the other triangular patterns. Usually it takes about 5 touches before it breaks out. All right. So usually wave 1 is the longest. Wave 3 must be longer than wave 5. The leading diagonal is also considered a motive wave, but not an impulse. It is a subcategory of a motive wave because it also has corrective characteristics. Wave 4 overlaps with the top of wave 1 and can be the wave 1 of an impulse or a wave A of an ABC correction. Its structure can be seen as 3, -3, 3, 3, or 5, 3, 5, 3, 5. For the leading diagonal, wave 4 overlaps with wave 1 and has a smaller retracement than our wave 2 as shown above. It is usually followed by a wave 2 in a motive wave or by a B wave in an ABC correction wave. All right, you guys see that? We're gonna keep it moving. We're gonna keep it moving right along, right? All right, where do I have this stuff hidden? All right, you know what? Let me just stop there. Let me stop there because then, you know, we could do this forever. All right, so long story short, ladies and gents, all right, the market consists of a couple of cool things, all right? We went over Fibonacci briefly, okay? Wick to wick, whether it's downtrending, uptrending, take a look at some of these levels, all right? It's important. You can use my fit bands, my doji scans to kind of help you identify certain opportunities. It was also discussed that MACD is a perfect counterpart, all right, to using the Fibonacci retracement tool. Okay, as we were looking at the Fibonacci retracement tool, we noticed that, all right, when you look at it from a line chart perspective, these are definitely Elliot waves. Elliot waves are happening right in front of us. There are layers and layers and layers of Elliot waves happening right in front of us. So it's evident when you're looking at how the market characteristics are using fib levels on a line chart, right? So whether it's up or down, the market is going to be respecting some of these levels, okay? MACD, we went over the rules again for MACD. We spoke on Elliot waves, okay? We spoke on motive waves. We spoke on a couple of different, you know, things over here. And so we're going to conclude this for right now, but I hope that you find this valuable. Again, we're going to cover some more stuff. Usually when we start talking about market geometry type of material, it's a little more advanced. So just keep in mind that if you missed out on all this and you're just getting into this and you're seeing what I'm covering now, you're like lost, that's okay. Just scroll up, okay? Scroll up. If you're on the Instagram Free Trading Blueprint, take a look at that. Scroll up. If you are on our Facebook community, scroll all the way down. Take a look at my material. Look at my YouTube channel if you want as well. You know, we also have a Discord, okay, where we send trade ideas, but that's for people that are already paid members. Right now, I'm giving a bunch of free value that you would never learn unless you're paying for it somehow, some way. Either you're paying too much attention, all right, which is still a form of payment, you know, or you actually paid a premium to learn about some of the stuff. So anyway, I'm giving y'all a game, but pretty soon we're gonna get active with just straight getting to the bag. Of course, we gotta cover a couple of different things so you understand what's going on. And if I do just a little bit more, like doing advanced topics like this, you at least have an edge over people that are not even close to paying attention. All right. What I like to do, I already have my chart set up with my templates already here. You know, ready for a quick switch on it. Got my asset strength meters right there. All right. I can also take a look at what's going on over here. I can also look at some of these analysis, you know, news as well. So, you know, just lots of things that we can pay attention to, and it is pretty cool actually. You know, all these tools are here for us to just look at what's going on with the financial market, all right, and make some moves while we're in it, okay? I blast these signals. We blast these signals over to our groups, and so everything is going to merge to one this month. I'm actually waiting on a couple of different things to come together and fall in line. But I think Elliot waves is the last thing that I'm really going to cover before we get into harmonics. Okay, I know we covered harmonic patterns along with the candlestick patterns, but I want to actually show a tool that I use to identify harmonics or harmonic patterns. I think you're really going to like that. It's really going to be a cool experience for you to see. But yeah, you know, listen, the money's there. The money's there. All we have to do is grab it. All we have to do is stay consistent. All we have to do is pay attention. Straight up, that's what it is. Okay? Straight up, that's what it is. So with that said, you know, we'll get back on the charts next week. I hope you found these lessons valuable. I'll be dropping more Elliot wave lessons, and I'll throw in a harmonic lesson as well. But yeah, we're gonna get to the bag. You know, pretty soon we're gonna start really getting to the bag. So if you haven't done so already, follow all the steps that I gave you from the beginning of the chat. Just scroll all the way up, and you'll be able to be good to go. If you appreciate my content, you're looking at the replays. Comment, like, subscribe. For a long time, I haven't posted up anything on YouTube because I've always kept things like all private, secured websites where you have to be members to get access to, you know, certain information. But I think it's time. I think the timing is right that I start, you know, putting some things out there. But anywho, thank you so much for tuning in, ladies and gentlemen. I appreciate you, and we are off this. Peace.